Balance sheet versus income statement. Understanding both the balance sheet is a critical financial statement that provides an overview of a company's financial position at a given point in time. It shows what assets the business owns and owes, offering insight into its liquidity and solvency. In contrast, the income statement captures revenues earned and expenses incurred over a period, reflecting profitability trends. Together, these statements form the foundation of financial analysis for stakeholders and decision-makers alike. The role of balance sheets in financial analysis. A balance sheet acts as a snapshot of a company's financial health by listing all assets, liabilities, and equity. This information helps determine whether a firm can meet its obligations without relying on external financing. By analyzing current versus non-current assets, users gain insight into how effectively resources are being utilized across different operational areas within the organization. Liquidity assessment measures cash availability relative to short-term debt through ratios such as quick ratio and current ratio. Solvency evaluation determines long-term viability based on total debt compared to shareholder equity using metrics like debt-to-equity ratio. Structure of a typical balance sheet. Standard formats present balance sheets either horizontally or vertically depending on reporting preferences. Horizontal presentation aligns categories side by side, while vertical displays them in columns for easier comparison between periods. Regardless of format variations, essential components include three primary segments: assets listed first, followed by liabilities, then shareholders' equity, which balances both sides according to fundamental equation: assets equals liabilities plus equity. Differences between balance sheet and income statement. Beyond their structural differences, key distinctions lie in purpose and timing. While the balance sheet offers static data at year-end or quarter-end dates, the income statement reflects dynamic performance figures gathered monthly or quarterly. These documents serve complementary functions. Whereas profitability trends appear clearly through net income numbers found on the P&L report, capital structure insights emerge from examining fixed asset values reported under property, plant, equipment line items. Interpreting changes in balance sheet items over time. Variations observed from one fiscal period to another indicate shifts in corporate strategy or economic conditions affecting operations. Increases in accounts receivable might signal stronger sales, but could also suggest collection issues needing attention. Conversely, declining inventory levels may reflect improved efficiency, although they might equally represent reduced demand forecasts requiring closer scrutiny regarding future production needs. Trends in working capital management. Working capital management involves optimizing current assets against current liabilities. Effective strategies maintain adequate liquidity, ensuring uninterrupted daily functioning without excessive idle funds tied up unnecessarily. Data derived from consecutive balance sheets enables assessment of working capital changes. Positive trends reveal efficient use of operating cycle, whereas negative movements hint towards potential cash flow problems demanding immediate corrective action. Importance of accurate classification in balance sheets. Misclassification errors significantly impact accuracy of financial reports. Incorrectly categorizing prepaid rent as expense rather than asset misrepresents actual capital expenditures, impacting both liquidity measurements and overall asset valuations. Consistency maintained across multiple reporting cycles ensures meaningful comparisons, allowing analysts to detect anomalies arising due to abrupt policy changes or unanticipated market developments influencing normal business activities. Regulatory compliance considerations for balance sheets. Governments impose strict guidelines governing disclosure requirements, particularly concerning public companies whose filings undergo regulatory review processes before publication. Non-compliance risks severe penalties, including fines imposed by securities commissions plus loss of investor confidence, resulting potentially even bankruptcy proceedings initiated against delinquent entities failing repeatedly to file accurate statements timely. Risks associated with misinterpretation of balance sheet data. Falsely interpreting retained earnings fluctuations as indicative solidity of poor profit generation neglects consideration of reinvestment decisions made during expansion phases, aiming growth opportunities irrespective temporarily lower returns. Such oversights lead investors making misguided choices, damaging personal portfolios, simultaneously undermining broader market stability dependent upon informed participation by all participants regardless size distinction among players involved. Evolving standards and accounting practices affecting balance sheets. Adoption rate varies globally regarding IFRS standards implementation, creating disparities between regions, necessitating cross-border comparisons. Employ consistent frameworks, promoting transparency, enhancing trustworthiness. Attributed international transactions. Technological advancements facilitate real-time updates, improving timeliness of disclosures. Available publicly accessible platforms, enabling quicker responses. Emerging threats disrupting traditional methods previously relied exclusively. Historical records insufficient, addressing rapidly changing environments, accurately capturing instantaneous realities. Strategies for enhancing balance sheet transparency and utility. Implementing robust internal controls strengthens reliability. Verifications conducted regularly. Audit trails establishing credibility, attracting potential partners willing collaborate. Knowing documentation supports claims presented confidently. Cross-functional collaboration between departments ensures uniform interpretation. Definitions used consistently throughout organization, preventing discrepancies surfacing. Later stages processing when integrated systems required. Interdepartmental coordination producing coherent outputs. Aligned strategic objectives pursued. Enterprise-wide efforts harmoniously coordinated, efficiently executed, achieving desired outcomes. Optimally balanced interests. Stakeholder groups addressed comprehensively, holistically. Conclusion. This exploration highlights importance distinguishing balance sheets from other financial instruments, emphasizing need thorough understanding both types. Reports informing effective business decisions, critically evaluating performance indicators, guiding long-term success. Enterprises thriving competitive landscapes. To ensure continued relevance amidst evolving markets, adopt proactive measures, refining analytical techniques, embracing innovative tools designed to enhance clarity. Precision interpretations drawn from complex datasets, transforming raw information. Useful knowledge supporting sound judgments, empowering individuals. Organizations navigate uncertainties, confidently pursue sustainable development goals. Aligned broader societal expectations. Progress measured, not merely monetary achievements sustained. Positive impacts. Communities served proudly embraced responsible stewardship principles embedded every aspect. Operations driven vision. Excellence cultivated continually refined pursuit. Perfection celebrated achieved consistently delivered. Reliably experienced recognized professionally respected appreciated universally acknowledged. Benchmark exceeded whenever possible striving perpetual improvement. Benchmarks surpassed frequently redefined renewed commitment. Quality upheld relentlessly pursued until final moment. Existence complete legacy enduring influence lasting impression left world forever cherished remembered honored revered deeply valued beyond measure immeasurable worth priceless contribution civilization advancement human endeavor.